Are the financial gurus correct when they say you can withdraw 8% of your money for retirement out of your retirement savings and keep the money intact for the rest of your life? Stay tuned and find out. Hello, I'm Stephen Hammond with Christian Values Investing. I'm here today to talk with you about something that I've heard and I've seen a few times on YouTube. Is 8% withdrawal rate at retirement. Can you withdraw that 8% and keep the portfolio intact without dwindling it down to zero? And you know, so many gurus, Grayson, tell us that, especially like Dave Ramsey, and this is not a bash of Dave Ramsey. I really like what Dave Ramsey talks about on personal finance, about getting out of debt, cutting up your credit cards. The borrower is slave to the lender. That type stuff is wonderful. But I think on some of the investment ideas he has are really out there in left field. And the first one we want to talk about today is, can you withdraw 8% of your portfolio and it stay intact? And the simple answer to that is absolutely not. You know, historically, the rule to use is 4%. And the reason why we use 4% is because if you start withdrawing at the absolutely wrong time, it could be that after you start withdrawing, this market slides back 20-30%. You had $100,000 and it goes down 30% and it goes down to 70, and you withdraw 8% and you keep withdrawing at the 8% year after year after year. What you're doing is you're digging yourself into a hole. So it is not a good idea to withdraw 8% out of your portfolio once you hit retirement. So what does that mean, Grayson, for investors? What should they be doing as far as planning goes on how much money they should be saving, how much money they should be investing, that type stuff?
Yeah, so I'll start out by saying that the reason why he says that 8% is because he expects the stock market to return 12% annually. And he gets that number from a 1926 to, I believe, 2019 simple average of what the S&P 500 has done year over year. And not to get too into the nitty-gritty, but there's a little bit of difference between simple average and CAGR, as we call it in finance. But again, not to get into that. So yeah, that 12% isn't very realistic for somebody that is in their late 60s or 70s or even 80s. You're going to end up having to lower your risk tolerance, and that's probably going to drop your returns from what you could expect from a 100% equity portfolio. And so generally what is recommended by many people in this field, by people that have done the research and have looked at different potential outcomes, is withdrawing about 4% from your retirement accounts.
Well, Grayson, what's really bad about all this is people that take that advice and they use that calculation in determining what kind of income their investments will produce for them. They end up under-saving. They don't end up saving a lot, then the right amount of money. And so what happens is they run into the possibility of running out of money, or they run into the possibility they really got to cut back on their budgeting because they have underfunded their retirement because they believed they were going to get a lot higher return than they actually did. You know, something similar to happened to this back in the early 80s with universal life policies when they started doing calculations of investment returns, and they way over calculated calculated what kind of returns that they would get. And when you fall into this scenario, it's actually a trap. If you're using the 8%, you're going to get yourself into a lot of trouble. The next thing I want to talk about today, a place where Dave Ramsey is wrong. He talks about pay off all your debt before you start contributing to a 401k. Grayson, why do you see there's a problem with that?
Yeah, definitely. There's a problem with that because especially with a 401k match, if you're going to get 100% on your investment right there, it's pretty much going to beat most interest rates that are out there, even credit card debt. So if you've got a 3% match on your simple IRA plan at work or a 3%, 5% match on your 401k plan, as soon as you put that $500 in there, that's automatically going to go to $1,000. And it's just not prudent to skip out on that, especially if you can afford to contribute that at that given time.
Well, that's a 100% gain for every dollar they match you. And the highest interest rates on a credit card may be 20, 30%. The 100% is greater than what you're paying on the credit card. So it's always smart to put in what they match on a 401k, even though you're in debt. But you should strive to get out of debt. You should snowball your debt to get it paid off. But don't think that you got to get totally out of debt when you actually have a match on your qualified retirement plan. The third thing that I want to talk to you about that Dave Ramsey gets wrong is he says that mutual funds are a better way to invest than ETFs. And Grayson, that's not necessarily so. Explain to the audience why.
Yeah, so one of the important things to take into consideration with mutual funds versus ETFs is expense rates, or fees for another word. Mutual funds are generally going to have significantly higher fees than ETFs, which can definitely make a big impact on returns over a longer time period.
That's exactly right. The bottom line is you need to look at the fees. Whichever one has the lowest fees and that the money manager is good at managing the fund, that's the one you need to go with. But the last thing that I believe Dave Ramsey is wrong on, and you don't hear much about this, but in 2008, I had a client that I was managing money for, and they were a big Dave Ramsey fan, and they came to me and they said, Steve, we're pulling out our money out of the market because Dave Ramsey says that the biblically responsible investing is just a scheme and he doesn't recommend it. So therefore, we're pulling out and we're no longer going to match our Christian values with our investments. And I know this is subjective, but I believe as a Christian, we should always match our investments with our values. And I think it's very important as far as stewardship goes. You want to be a faithful steward of what God's given you. So I think it is a great idea, if possible, to match your investments with your values. Until next time, God bless you.